Are we live? You need to give me the thumbs up. Yay! Hi, everybody. We are live today, giving you the lender's edge. This is Alicia Alt with Credit Score Pro, and this is
Ivory Becker,
with what?
also Credit Score Pro. Bear with me. Sorry, I'm getting the technology side of things just set up a little bit so we can get going here for everyone that is live. So, Allie, I'm going to let you talk a little bit while I get things going on my end.
Okay. I don't know what I'm going to talk about, but we are going to talk about lender's edge. So this particular live is for our lending audience, for real estate agents, for those of you that are in the industry who may come in contact with clients that are credit challenged, or maybe they have debt to income ratio issues, and how Credit Score Pro can help them. There we go. You're doing it, girl.
Okay. All
How
right.
Credit Score Pro can help them, and also some tips and stuff that we can provide you today.
So you should be able to see my screen now. For those of you in chat, if you cannot see my screen, let me know. And then as a reminder, in case you've never attended one of our lives before, whether you're just viewing, or whether you're here with us, we want to know your questions. If you are on today's live webinar, you can put your questions in the chat. We will answer them throughout. And if we run out of time, we will make sure we reach out to you individually. And your questions help us to make sure we're tailoring today's material so it works for you and it's usable. Other than that, it also helps us decide on the next topics.
Very good.
Okay. Allie, let's start with you. Who are you?
Love to start with me. You like put me in this. Yeah. So I'm Alicia All. I am co-founder with Ivory of Credit Score Pro. And just a little background about me. I have 20 plus years of experience in the credit industry, in the lending industry, real estate. I love this space that we're in, but I dedicated my time and efforts in the last 15 years to really just working on the credit side of things. So helping people
Mm.
get from where they're at today to be able to open the door to buy a new home and things like that. So that's my background. Ivory.
So I have a similar background, but more heavily focused on the regulatory compliance side of things. So really just understanding the laws and regulations that impact creditors, and how they relate with the bureaus and collection companies. So spend a little time on the collection side of things, dealing with foreclosures, dealing with short sales, deed in lieu, really anything around default. Also financial planner for quite a while, and then some background in the lending space as well. But like Allie, the vast majority of my recent history is really heavily focused on credit repair and credit education. And that's part of why we are here every week. 1 week on for professionals, 1 week on for consumers, so we can help everyone understand credit, hopefully as well as we do. So the expected outcome. So at the conclusion of today's live, we really hope you're able to walk away with some key concepts. Number one, understanding how you can have the edge in today's market. And we'll discuss what that means. And it's really about that competitive edge. And then understanding how credit options can be a solution for your client's credit trouble. So what are those credit options? How can you utilize them? And where can you identify those resources for your accessibility? So let's talk about the problem for lending professionals in today's market. And I'm going to dive into some data. Everybody loves looking at the numbers. They really tell a story. So did you know that only 35% of leads actually close on a home loan? That's from the time you get an inquiry all the way to applications and then to closing. It's a huge fallout of people that you think you may be doing business with. What's interesting is this is data from a typical market. This isn't data from the market like what we see today. We'll talk about what today's market really looks like. Now, the overall reason that causes a decline for a mortgage is credit history and debt to income ratio. And they really go hand in hand, right? If somebody is having credit troubles or has a lower credit score, they tend to have a higher debt to income ratio, right, Allie?
Yes, of course. And I think this is a great slide actually, because it really shows where mortgage lenders and professionals struggle because, yeah, we get tons of leads. And I know back from my history of being a lender, get a lot of leads in. But I would say a majority of the leads that we would get in were credit challenged people or debt to income ratio challenged people. So this is, and they do go hand in hand. A lot of times if you're, you're extremely maxed out in debt, you have a bad credit. And sometimes it's a fix of just handling that debt to income ratio problem. And now the credit
Mhm.
issues fixed. So it's not necessarily
Sure.
that they have late and other negative things on the credit report.
And one of the things we have found is there's a lack of resources available to professionals, whether you're in the mortgage lending space or the banking space, to really solve these issues. And we'll talk about some of the solutions we can provide to help you through those issues. So let's dive into today's market. It's created a new barrier for many professionals. Allie, I'll let you talk a little bit more about this because you have such a strong background in the lending space.
Awesome. Okay. So today's market, we have higher interest rates, right? We're having issues with the pricings of homes and the collateral being able to be appraised. Those are big issues right now. And so because of that, people are struggling to get those home loans done. And one thing that I've been stressing to a lot of my lending professionals that I know and real estate agents is that this is still a very good time of the market if we focus our attention correctly. We have to understand the market. We have to turn our attention to what is going to work in this market. And right now, those people who are credit challenged need homes, want homes, and they really don't care that the interest rates are higher. Now, would they like, just like everybody else, have the lowest interest rate possible? Absolutely 100%. But they are more, their struggle is mainly that they want to get approved. And so it's our chance at this point in time to help those credit challenged people to get to the state where they can get approved so they can get those home loans, especially before my take on this is before spring, when we do have a new rollout of homes where now they're going to be competing against those prices again. Right now, maybe you're going to pay a higher interest rate. And I'll talk to everyone about this actually, whether you got your credit challenged or not, those people who are not credit challenged in the market space right now, who are waiting for the interest rates to go down, what you don't realize is that home prices have gone down because of people are not out there looking for homes.
Supply and demand, right?
Right. So you can actually go and put an offer on a home lower than the listed price, right? That hasn't been the case in the last year and a half, right? If you went to go put a bid on a home, you're going to have to bid higher than the list price, right? Because the next person's going to, if you're going to get that home. And right now, you really have a competitive edge to go to that seller and get a lower price than what they're listed. And we haven't seen that in a while. So this is the time to do it, whether the interest rates are higher or not. You can always refinance an interest rate, but
Right.
you can't change the price of the homes, right?
Right.
That's going to go up in the spring.
And I think I'll add to this a bit. I think what we've seen is a pretty heavy focus on that ideal type of client the last several years, right? That client with the perfect credit score, that client with the great debt to income ratio. And really, what we're seeing in today's market is a shift in the type of client that's coming to you to acquire lending products.
Absolutely. Yeah.
And I think this is something we often forget is the perspective of the consumer, right? When a client wants to, or anybody, when somebody wants to start building wealth, the first thing they commonly think of is, I want to buy a house, right? That's my next step up in life. You go from getting your first job, you get ready to have a family. Once you have your family, or maybe right before you have your first baby, you want to buy a house, right? That's your next step up in life. And that's really the entryway to building wealth. So we want to make sure we help to clarify why someone must buy a home, why it's so important to their financial futures. And one of the stories I'd like to share is one of our partners that does work with us. She has a story where she bought her first home when she was 21 years old. Everybody thought she was crazy in her family buying a home that young. She didn't even really know what the impact was going to be. She just thought, oh, I should do it. Well, when she was 25 years old, so 4 years later, she was able to sell that home and have $80,000 in profit. That's $80,000 she now had as a 25-year-old. Most 25-year-olds don't have that sort of nest egg to create a launching pad for the rest of the trajectory of their lives. So you helping someone to be able to transition into a home is life-changing, not only for them, but for their children. I don't know if there's anything you would like to add here, Allie.
No, I mean, you said it all really well in a story way as well. And I hear those stories a lot, but definitely it is absolutely a lot of people's first stage in building
Mhm.
wealth. So yeah, I agree with you. It's a must.
And one of the interesting statistics that stems from home ownership is households who are homeowners have 43 times more wealth than households who rent. I mean, let that sink in. That's 43 times more wealth.
And I think we can all agree that part of that wealth is that they're building equity in the home.
Mhm.
I've had people in all kinds of walks of life and financial advisors and stuff and say, hey, if I could do it over, I would have been um, a property investor because you're always going in up market. It's very, very unlikely that you're going in a down market. If you do, it rebounds pretty fast rather than some types of investments that you can do. So it's a great investment.
Sure. I believe in diversifying assets, and homeownership is a wonderful asset to have. Everything's a tool, it's all in how you use the tools. So it's my philosophy. So let's talk about the opportunity. So the part of the market that no one's looking at. So I'm going to start by diving into the numbers. So 19 million adults lack a credit score. 37% of adults have a credit score below 700, and 16% of adults have a credit score below 579. So what does this mean for you? What it means is there are more people with suboptimal credit scores than optimal credit scores right now looking to buy. Why is that? A lot of the individuals who already purchased or refinanced their home are planning on staying put, right? They're at the 2.5%, the 4% interest rates. The only reason they're going to acquire new properties is maybe if they're managing investment properties or if they need to move for some sort of a reason, right? They get a new job, they want to be closer to family. But the vast majority of people out there looking, like Allie had talked about before, they aren't afraid of the higher interest rates. They may already be used to having higher interest rates if they have lower credit scores already. So this is the part of the market that's looking right now. Those sub 700 and even those sub 579 who were often ignored the last couple of years if they went to a real estate agent or a mortgage loan officer to try to get a mortgage because there was too much good business happening at that time. So competitors are still searching, your competitors are still searching for those perfect A+ clients, but this is an untapped section of the market that you can really take advantage of. I don't know if there's anything you want to add in there, Allie.
No, I was just talking to a realtor today, and actually, I think he's on
Mm-hmm.
this. I think I just saw him on this
Mm-hmm.
Zoom, but uh, he was talking about how uh, he had not originally been seeking after those people who were credit challenged. If they had small little issues and he could
Mm-hmm.
run it through his Wayfinder, then, and it gave him some small little things, he would work with those clients. But if they weren't in that position, then he just kind of, I'm sorry, you got to work on your credit, kind of let them go.
Sure.
And he's like, I like shoot myself in the foot now because I realized that that is an untapped market that I could have been building and building a relationship with. And it's a really cool thing about working with people who are credit challenged and getting them ready to buy. That my favorite thing, and I did it my whole career as a loan officer. I was a first-time home buyer specialist. That's what I built my career on. The best thing ever is when you help someone, they are inclined to tell everybody in the world about you. They will
They're
not be able to stop singing your praises. So
the best
there's the
referral source.
best referral source.
Mm-hmm.
And you look like a hero to them, right? So you feel good. You feel good about what you did in the day, walk home at the end of the day, and like I helped someone get a home. But they're also just singing your praises out there to the world. And I had one loan officer said, yeah, but they're singing their praises out to people who are just like them. And then I'm just going to have more credit challenged. So what if that's the case? Because you can fix it, right? And then you get more in your pipeline. Or number two, that's not necessarily true either. But I just think it's an untapped market. And I think people are seeing that now, especially with where we're at. And what a great way to start the 2024 with tapping into that market that is, they're desperately seeking that help.
Well, and let's look at what that pipeline looks like, right? If you're closing even 5 and let's say even 10 more loans per year because you've built up this robust pipeline, I mean, you could significantly close more than that, right? If you've built up a pipeline of credit challenged clients. But we know some of the people who do work with us here at Credit Score Pro, I mean, they're doing big numbers because they've built this structure into their business. If you're someone who does advertising on social media, right, like Facebook ads or Instagram ads, how many of those individuals that respond to your ads are highly qualified? And how many of them have credit challenges? My guess is most of them have credit challenges. And what are you doing with those folks? Are you letting them drop off? Or are you doing something with them? Are you building them into your pipeline so you can turn them into a successful transaction later and build that strong relationship that's not only going to give you that one loan, but likely to give you a refinance later and likely to refer you to all of their friends and family, like Ali had mentioned. So switching gears a little bit, 22% of adults have a credit score of 800 plus, and 1.2% of adults have a perfect credit score of 850. So if your peers are chasing this 22% and this 1.2%, there's a whole lot of lenders, a whole lot of realtors, a whole lot of bankers out there going after a tiny little bit of the population. So that makes it very hard to do business. So these people are not in the house to buy. Well, my grandma's a little my grandma's a little off there on that side, but these people are not looking for a house to buy right now or even trying to refinance right now, right? As I mentioned before, they're keeping their 2.5 to 4% interest rates.
I had a client today tell me that. Yeah. She's like, I'm staying put. I got 3.5%. I'm not going anywhere. And that's the truth of the matter. But there's so many people in the market looking to buy a home who are getting denied and they don't care. You know, they don't have the 3.5%. They don't even know what that looks like. Never seen that a day in their life. Right. So, but, and I think, you have to also educate the person, right? If you do have a client that's looking to buy and they are interest rate shy, you will find that even with credit challenge people, they're like, well, maybe when the interest rates go down, this is still like, I will not, I'll preach this to the mountains. It is the best time to buy. You can actually negotiate on the listing price right now. Okay. You're not paying 22. I had one loan officer tell me that it was a loan officer. Yeah. Loan officer that his client bidded on a home $200,000 above list price. What kind of world is that, right? We're not there. We're not there right now. Right now, we can actually negotiate that list price. So I don't care. I would pay that higher interest rate all day long to get a lower price on that house today than what I'm going to have to pay when these interest rates go down.
Sure.
Because I can refinance that loan. That's easy stuff, right? So I don't know. I just got on my little pedestal because I'm like hyped up about this. Like, I'll go out buy all the property right now. This is the time. This is the time.
So let's talk about the problem for consumers right now. And this is the problem that you are the solution to. There's no life lesson on credit or on home buying. So they know that they want to buy a home. They know that they need to have good credit to buy a home, but they don't know how to bridge that gap. So how often are you hearing, well, I can't buy right now because of my credit? Does this stop the conversation for you? And if it does, then you are in the right place today. This is the right live to be attending. What other objections are you getting? Are they all around affordability? Are they all around credit? Because usually it's around that sort of area, at least right now for the time being. And a realtor would never let someone's Zestimate stop them, right? On Zillow, the Zestimate for the home, right?
I think
And it's the
realtors
same
don't
thing.
like it.
Yeah. It's the same thing for mortgage pre-approvals or even for fixing the credit. Um, Basically, don't let people turn you down. You want to turn it into an opportunity for educating and for helping to be that problem solver. It's usually just a natural defense mechanism, right? So, so now we want to shift gears. We talked about how you can be the advisor, how you can turn that I can't into I can, but let's bridge that gap knowledge-wise for you. So understanding scores helps you to be a reliable advisor, right? We don't just want you to be a mortgage loan officer, a mortgage broker, a real estate agent, a banker. We want you to be the advisor so that that client comes to you for every need, whether it is for that transaction or for a referral to another professional that you trust. Because if you become their advisor, you are now their starting point for every transaction that they need to do from that day forward and the referral source for them as well. So there are 5 primary factors that drive a credit score. We've got number 1 is payment history. So I think everyone here is most likely familiar with payment history. Do you pay things on time? Now, important for you to realize, and I'm going to focus on these categories more for giving you the edge over others in your field. So payment history is not just about what you are paying, but it's also about what you're not paying, what you're not using. So a good example is your credit cards or your client's credit cards. If they're not actively using credit cards, if they become stale, then those credit cards are no longer going to factor into the credit score algorithm. If they're not using credit, they're not getting the benefit of this 35%, right? We want to make sure that our clients are not credit invisible. So payment history is a huge factor. Obviously, more on-time payments, the better. So we want to make sure they're using credit effectively. Amounts owed is looking at credit utilization. So this is going to be the balances on their credit cards versus their credit limits. This is not heavily focused on things like loans. So you're not going to advise your clients to pay their loans off instead of paying credit cards off. Credit cards are always going to be the way to go to help that credit score. Allie, anything you want to add for those first 2 categories before we move on to the next 3?
Yeah, when we talk about amounts owed, like Ivory said, credit cards are the way to go. Like we're going to pay down credit cards to get that utilization ratio down. That's going to impact the credit score more. The only time a loan is really a part of that factor is if, for instance, and this happens with student loans, you get a student loan out for $5,000, it's deferred, it's a unsubsidized loan, federal loan, and it's gaining interest all that time it's deferred. So like students, college students in school right now, if you have an unsubsidized loan, and you're not paying a payment on it, your loan is growing above the original loan amount you got, this is going to start to decrease your credit score, right? Because credit is a factor of your risk for fundability, right?
Mhm.
So it's really important for people to know that. I tell parents all the time and grandparents, I said, hey, if you want to give your college student a gift, apply a payment to their student loan for their birthday. College students don't like that, but they will when they become adults. But that's the only time that I really suggest if there's a payment to be made on would be on a student loan to get it back down to at least that original loan amount.
And the next category is length of credit history. Now, this section is really important for you to understand you don't want to be recommending your clients to close accounts. That's going to impact the average age of accounts on their credit report, which is looking at open and active products, right? Looking at open and active loans, open and active credit cards, really any open and active debt. So the second that that client pays a debt off or closes a credit card, all of a sudden they're seeing a decrease in the average age on their report. So if you have a client, let's say their debt to income ratios are higher and you need them to pay off a debt or consolidate a debt, etc., do that as part of the closing of the loan. That way you're not seeing the length of credit history shorten. And at the same time, you still do not have to consider that debt as part of their debt to income ratio. So I
I
don't think
like
I've
that
forgotten
one.
anything there.
No, I like that one. I use this a lot. So a person has a auto loan
Mhm.
and their payments are too high. Their credit scores are good enough where they can refinance the auto loan, get a lower payment. Your DTI issue, you have a DTI
Mhm.
issue as a loan officer. So what I've always done is we will refinance that auto as part of the loan process, but we don't initiate it until we pull credit, approve the loan,
Mhm.
meet a DTI decrease. We refinance the auto, get a document
Mhm.
from for the new loan showing the new payment, and we run with it.
There you
Um,
go.
yeah.
Solid. Next two categories, types of credit used and new credit. So credit mix is the types of credit used. It's really going to be looking at the blend of different types of accounts on the credit report. So ideally, you want your clients to have a mixture of different types of accounts, meaning some revolving debt, which would be things like credit cards, and some loan history. There are different tools available that we do have through Credit Score Pro that can help with that credit mix without your client having to take out new debt and adversely impacting their debt to income ratio. And then lastly is new credit, which is really looking at primarily the inquiries on the credit report. So in this section, I think what's most important for you to know as a professional is if your client is applying for a mortgage, an auto loan, or a student loan, it does allow for shopping around. This means that inquiries within a certain time period for that type of debt are only counted as one inquiry on their credit report. You're going to see multiple inquiries, right? If they've applied for an auto loan and that dealership ran their credit through, I don't know, 20 different lenders, you'll see each inquiry for each lender, but it only impacts the credit as if it's one inquiry. Um, it's similar for mortgage lending as well, right? So not going to be that way for credit cards, not going to be that way for other types of loan products like personal loans, for example, debt consolidation loans. But for your clients who do have those questions around inquiries, it's good to be armed with that knowledge base and that understanding of how their credit will be impacted. So again, you can be that advisor for them. And you should also know that FICO is not the only credit scoring system. So when your clients are coming to you telling you their credit score and they're using any sort of free platform, so most common would be Credit Karma. Um, this is what's known as a Vantage credit score. So it's not the same credit score that you're using in lending. If you are a mortgage lender, you're using FICO Classic. If you're in business banking, most often we see FICO 8 being used, but it's just important to know that there are Vantage credit scores and there are FICO credit scores. Most of your clients aren't going to be seeing the exact same credit scoring algorithm that you see when you pull their credit, excuse me. Anything you'd like to add about the credit scoring systems, Allie?
I guess I just want to say that there is a common thing that loan officers say specifically
Mm-hmm.
that is in relation to some things that they heard. So when FICO 9 came out, there was a lot of things that were talked about where, medical debts are not as don't
We'll
have as
talk.
big of a weight on credit scores than other debts. And that's not true on the mortgage credit report. So you just said we're going to talk about that later.
Mhm.
Okay. Yeah, because that's a big one, right? And I'm sure we're going to get questions in the chat about that because I just opened that up, guys. You're telling people that it doesn't matter if you have medical collections. I'm going to tell you, you're telling them wrong. And we'll tell you why here later.
Yeah, yeah. So we have a small section on collections, so we'll just save any questions on collections until then. Um, One of the things I thought would be great to show you is the difference between the FICO credit score algorithm and then the Vantage algorithm, really so you can see the weighting difference between payment history, credit utilization, etc. Being able to visualize this will help you to understand why your clients are confused when they see different credit scores. And as you can see, the FICO credit score, the standardized FICO credit score is from 1989. And then the Vantage score is newer, created in 2006. Ali, is there anything you wanted to touch on here between the two algorithms? I have a little comparison chart coming up too.
I was going to say, I think it's pretty cut and dry, but yeah, I was say show the comparison chart.
Okay. So here's our comparison. Vantage scores are almost always free. FICO scores are never free. My exception to that, of course, is if you go to Experian.com. Experian does allow you to get the FICO score for free. My non-research, non-necessarily valid opinion on that is because they're trying to sell you so many products once you create an account in there with them. So it's to
And wait
their
a minute, have you seen the report itself? Like for the
they
for
give you the
consumer?
score and they give you the items on your credit. So it's not a full report.
Oh, okay. Because I know if you get the free Experian account, that report is so hard to read for everybody. It's not, they
Yeah.
don't make it easy for sure.
Yeah, so on Experian site, what will happen is they will allow you to go to the different sections for the different items on your credit report, but it's not going to give you, it's not a real credit report. It's not going to give you all of the data, all of the history that a true credit report would. Um, so some of the other differences, VantageScore is primarily used as a marketing tool for a lot of different what would I call them, like internet companies. That's definitely not the technical term, but places like Credit Karma, right? They are able to utilize that data that they get from the scoring system to try to sell consumers products. They are paid for through advertising. So essentially financial companies pay Credit Karma to advertise their products to the consumers they have access to and essentially pre-qualify those consumers and sometimes pre-approve those consumers for products. The FICO credit score is the industry standard, right? So about 96% of lending decisions are based off of FICO credit score models. FICO credit scores, most models, I'm going to say most models because the newer models are slightly different, are more stringent with derogatory payment history than most of the Vantage scores. And we currently, potentially subject to change in the future, would consider a FICO score a bit more reliable for anyone who's applying for debt right now. My caveat to that is both credit scores are going to help a client to understand credit worthiness in certain ways, right? They're going to see negative information on their report. They're going to see positive information on their report. It's just the way that information is interpreted does vary across the two systems. Okay, so let's talk about the lender's edge. How can you have the edge on your competitors and get more prospects and then also keep them? So we talked a bit about this already. Do not assume inquiries are the problem because inquiries rarely are the issue on your client's credit report. It's usually something else. So, Allie, when it comes to some of the scenarios you've seen as a loan officer, have you ever had clients or worked with loan officers who have come to you and said, "Oh my gosh, I got a new inquiry," or "You pulled my credit, now my score is just completely tanked because of that inquiry"?
Okay, I'm so laughing because I've been I've seen it all, I've heard it all. My
Mm-hmm.
favorite was I got a voicemail message from a client and he was devastated. He's like cussing the voicemail message because he went to an auto lender and he's like, they pulled my credit 40 times and they totally destroyed my credit. And I had to call him up and let him know that absolutely that was not the case. And it was actually that he didn't pay his credit card on time.
Oh no.
Yeah, and actually I had that similar thing happen today where, people will get very they think something in their head is going to negatively impact their credit. And even though the real obvious thing is there, they will blame it on the thing that they don't have necessarily control on.
Mm-hmm.
And I feel like that's with inquiries. They're like, I don't have control over inquiries. There's too many inquiries for these
Mm-hmm.
auto lender did this to me. And so they want
Right.
to put the blame on that versus what is an obvious thing that was in their control that they didn't handle. But yeah, this is common. Yeah, very common.
Now, Allie, we have one question. It says, well, what is usually the issue if it's not an inquiry? So I suppose what's the
Usually,
most common issue?
um, if it's like it just happened and they've got the inquiry and also their score went down, I typically see two things that in my experience, I typically
Mm-hmm.
see. It's either credit utilization went up,
Mm-hmm.
that's a big one,
That's what I
or
see
they
the
got a
most.
new late payment or they got a new collection.
Mm-hmm.
Those things happen and they can happen at that same time, right? Also, little side note on inquiries is that when you go to a loan company or any company and you're trying to qualify for something, that information is shared with LexisNexis, who shares that information with debt collectors. And now they have your new information, maybe your new address, your new phone number. So sometimes I'll have people say, well, until I got my credit pulled for the mortgage, I never had this collection people calling me. Now they haven't called me. And I'm like, well, that's because now your information's there. Um,
Mm-hmm.
so so that might be something that people should be aware of. But
Yeah,
as
absolutely.
far, as far as inquiries hurting their score, it's very rarely the case that inquiries
Right.
did damage to them, unless you're a business. We're not talking about business today, but business, that
No.
is background. Yeah, that's a whole
So,
nother topic, another day.
yes, and inquiries typically don't impact credit very heavily. The exception is going to be what we call a thin credit profile. So somebody with limited credit history, if the algorithm doesn't have a lot of data to go off of, then the inquiries are going to have a bigger impact. So, and just keep in mind, you can have 4 inquiries per credit bureau per year without any impact to the credit score. There's some allowability there for you as a consumer. So important
Maybe
information.
maybe one other thing to keep in
Mhm.
mind: inquiries only stay on the credit report for 2 years.
Oh, I was going to go right into that next.
Okay, great,
Yeah,
great.
so they only stay on the report for 2 years, but only actually impact your score for 1 year.
That was right. That
Fun
was my
facts.
next thing.
So,
Yeah, fun facts. So if you see a bunch of credit inquiries on your credit report, know that they're probably not, like we've said a couple times, not necessarily affecting the score that much. Um, but you can see them on there. And sometimes even when people say they see like inquiries on there that they didn't have, what's the word? They didn't apply for credit. But
mhm,
if you have credit with a particular credit card company or something, they're
mhm.
constantly putting inquiries on it because they're looking at how you're behaving as well.
Right. Right. But those aren't going to adversely impact your score.
I
Those
don't
are
think.
allowable.
Yeah.
So, that's not the proper terminology, but it doesn't matter.
It doesn't matter. Yeah. Just like if a utility
So,
company pulls your credit,
mhm.
that's not going to affect you in any way, shape, or form. But a lot of people think so when they just, they see the list of inquiries and then the thing is, oh, that hurt my credit.
Mhm.
And a lot of those probably didn't do anything.
So we're on to your topic that you were trying to jump ahead to now. So having the collection know-how. Now, this is important because you don't want to be improperly advising your clients when it comes to collections. You don't want to be making them spend money where they shouldn't spend money because that's money they don't have if they need a down payment, right? So we don't necessarily need money unnecessarily going out the door. It could be better spent on things like their credit card utilization. Let's pay down those credit cards. So I want to start with the basics. Let's say you have a client and they have a credit card charge off. That account is now closed. That full amount is past due. And let's say that company sells the debt to a third party collection agency. Now, what's going to happen for your client's credit is they're going to have one derogatory item for the charge off with the original creditor and a second derogatory item on their credit report for the collection. So now we've had one item impact that person's credit 2 times. Okay. So another important factor is an individual with overwhelmingly positive credit. If they see a new collection appear on their credit report, let's say they have no negative history, right? They're going to see a bigger drop on their credit score than someone who has just a slew of derogatory information on their credit report, right? And the reason behind that, or one of the main reasons behind that, is it is so outside of the norm for the person with strong credit to have this new severe derogatory item on their report. Um, Feel free to further explain that or use different language.
Well, remember that the credit report is a
Hmm.
live document, right? It's
Right.
constantly, it's living and breathing. It's showing what you're doing currently. That's why
Hmm.
even in the mortgage industry, we are really focused on mainly the most recent 12 months, but also 24-month history. Like that's what our prime, what we're looking for, right? So, but when you have a good credit score and all of a sudden you start having negative marks, that's an indication that something's wrong
Right.
financially. And so it needs to adjust that credit score because now we are a higher risk. And I think
Mm-hmm.
that's what you'll see. And yeah, like a client yesterday, he had 720 score. He
Mm-hmm.
went 30 days late on his Discover,
Mm-hmm.
and he is over the limit because of the
Mm-hmm.
late payment
Oh.
and needed,
Mm-hmm.
yeah, his score dropped 140 points. And he could not believe, he actually thought that getting the collection removed, there was a collection on his credit report that we removed. He told me that was what caused his credit score to drop.
Oh gosh.
And so I had to, educate him that, these are, you had a high credit score and then all of a sudden out of nowhere, you went over the limit and 30 days late. Yeah, that's a significant drop.
Mm-hmm.
It's a current, and that's the other thing. It's a very recent current event is going to drop your score more than obviously an older event. Right? Um,
And paying a collection is not going to help your credit score when we're talking about looking at a FICO credit score that's used in mortgage lending. Now, let's talk about Allie's favorite exception, medical collections.
medical collections. So, there's been some changes and the credit bureaus personally made those changes. So it wasn't government issued or anything like that. The credit bureaus decided that if the medical collection is under $500, they're no longer going to report it on the credit report. So first and foremost, if you're scanning through a credit report and you see a medical collection that's under $500, it's an easy removal. Like the credit bureaus want to know about that because something just wasn't coded correctly for them to automatically have it removed. And that does happen. So that's an easy removal. But if the medical collection is above 500, and I don't care if it's $506, it's going to be reported on that credit report.
Mm-hmm.
And if it is settled, paid, somehow it gets to a zero balance, right? Doesn't matter how it got there. That medical collection will be completely removed like it never happened.
Mm-hmm.
And so we're going to get a credit score increase from that. So, and this is one of my favorite topics because loan officers heard back when FICO 9 came out that medical debts don't have as heavy of a weight on the credit score as does any other kind of collection. So they'll say stuff like, oh, we don't care about medical collections, and their underwriters don't care about medical collections. But the scoring that you guys use, the FICO that you use, absolutely 100% cares. And it doesn't care that it's medical versus it was a AT&T collection, and they are weighted the same. And so when you are telling someone don't worry about medical, you may be missing the boat in helping them improve their credit because medical could be the key to take care of to improve the credit score to get them ready to buy a home. Whereas if you told them to pay the AT&T because you care about it more, in the underwriting perspective, you may have shot yourself in the foot because now they can't qualify for the home loan. So medical is a key way to improve a person's credit really fast. A lot of people have medical collections. Now there is a myth going out there, so I have to say this. And
I think this is probably going to go into the question we have in the chat.
oh, okay.
The question in the chat was, what if I pay or have sorry, let me read it again. What if I have my client pay the collection to $499?
Oh, I'm so glad that you said that. Okay.
So I think it was leading
Irene
into what you're
knows where I
saying.
was going. So she picked out that question on purpose because I'm hyping on this. There is a lot of talk right now that says, hey, if you have a medical collection, pay it down to under 500. And I'm going to tell you, I'll raise my hand to tell you that I'm one of those people that spread that myth.
Me too.
Yeah. And unfortunately, in fact, that is not true. You have to, sometimes you have to really read what they're trying to say. And if you read it, you have to read it like 10 times to figure it out. But what the credit bureaus really said was, if it's under $500, it's not on the credit report. If you pay it off, it comes off the credit report. But you can't pay it down to under 500 like most people are telling you to do, because the credit bureau said they are taking the amount from the original balance to decide if it stays on the credit report. So if you pay it down and the original balance was 1,000 and you paid it down to 499, it's still staying on the credit report because the credit bureaus are putting it on there based on the original balance of the debt. And I think, here's my theory before you chime in. I think my theory is people were doing that. They were trying to pay it down and then leaving out the rest of that debt outstanding with a collection company and not ever paying it. And now, medical providers were losing out on that income. So I think that's the reason. But I wouldn't, that I would expect, like, I see a lot of medical debts that are like 506 on credit reports, $506. And I'm like, did you add that $6 interest or something? Like you
Well,
did something.
now I want to clarify something too, though. You can still settle, right? A settlement doesn't
Absolutely.
mean that it's going to stay on the credit report. So if there was an agreement to settle for less, which is going to update the balance to zero, that will remove it.
Correct. Any way that you can get it to zero, it'll come off. And that's the goal. But
Now,
you
Allie,
can't just pay it down.
right. Did you happen to see if there was any guidance on stacking and whether they're able to stack bills onto each other to make one collection?
Yeah, that's a great question. I remember when the credit bureaus came out with this new rule
Mhm.
before it was official. I was one of the people that went to them and said, "Hey, wait a minute, something's gonna happen,
Mhm.
and medical providers, collection companies are gonna stack debt." So they are looking out for that too. They don't know
Okay.
if it's gonna happen. They're really not. They can stack debt. So here's how they can and how they can't. If you went to that medical provider on the same day and you had services, they can stack those. But if
Sure,
it's on
sure.
different dates and they're different types of services, they cannot stack it. So only if it's the same day. So that I did, but
It's
I
great
haven't seen
guidance.
stacking yet. I haven't seen a
Yeah.
lot of stacking yet, but I imagine we will. But they do have to follow those guidelines. It does have to be the same day, same provider, right? It can't be the collection company got two collections from two different medical providers, same day, same client, and stack it. They can't do that.
So it's really, really good information. I appreciate you diving into the medical side. I know it's common questions we get, so let's see. See if we have any other questions. Oh, we do have one more collection question. What happens if my client pays off their collection and the balance is updated to zero? I'm assuming not for a medical collection.
Okay. Yeah, because if it was updated to zero,
Yeah.
it's going to come off. So that's probably, you're probably right. So here's the deal. If you pay a collection and you update it to zero, you've now, number one, you've admitted fault to the debt, right? Number two, you've made it more present, okay, on that credit report. So it could actually effectively lower your score. And we have seen that before. I really look at when I'm making a decision with my clients of whether or not it might be okay. I'm looking for two things. One is, does the credit provider, the collection company who's reporting it, do they remove, do a pay to
Pay
delete,
for delete.
right? Like, do they do that?
Hmm.
Will they remove it if it's paid? If that's the case, great. Some of them do, so that's great. But and then the other thing I look at is, if I pay it, does it update the last date of reporting, or is this collection company updating every month? If they're already updating every month and I pay it to a zero, then I actually would improve the credit score. But if they're not and I make it active and if more recent, then I'm going to decrease the score. So there's a lot of factors. So I always tell loan officers, be very careful. There's a lot of things you're looking at to make a decision call on whether or not a debt should be paid.
Okay, let's look into some of the credit score myths. So common misconceptions about credit scores. So number one, checking your credit score lowers your score. So checking your own credit score does not have any impact on your credit score. So this is something that your clients may be afraid of monitoring their own credit. You want to encourage them that it's healthy behavior to monitor and be aware of what's on their credit. The last thing we want is them to apply for a mortgage, apply for an auto loan, whatever kind of product, and all of a sudden they see that there's something on their report they don't recognize, a delinquency that shouldn't be there, right? They can take action right away if they're aware that something exists. Myth number two, you only have one credit score. We talked about that. You have multiple credit scores. You've got a Vantage score, you've got a FICO credit score, and depending on the type of product you're applying for, whether it's a mortgage or an auto loan, they may be using different versions of the FICO credit score. Myth number three. Myth number three, a higher income means a higher credit score. Income is not part of credit. So that means regardless of how much money someone makes, they have the ability to have a high credit score. Number four, carrying a balance on your credit cards boosts your score. Now, you do want to make sure that cards are used. We don't want them to become stale. We want them used once every 3 to 6 months. So they remain active at the very least. But carrying a balance, especially a high balance, is not going to boost your scores. And number 5, closing old accounts improves your score. We talked about that already. Closing accounts will adjust the average age of open accounts on your credit report. Okay. Now let's go into some of the pre-submitted questions. So those of you that registered for the event, we pulled a couple of your pre-submitted questions so we could talk about them. So I know some of you have asked similar questions to this. I have ignored them only for a reason, because we were getting to them at this point. So what's the easiest way to get out of debt, raise the credit score, and be ready to purchase a home? So this is a very loaded question. Now,
Yeah.
Allie, I'm throwing you a softball. Let's see if you can take it. What is the easiest way to deal with all of these things?
So easiest way, let me read this for a second. Easiest way to get out of debt, raise credit score to be ready to purchase a home. Easiest way. I'm going to say paying down credit card debt.
Okay, I'm going to challenge your answer. The easiest way is to use Credit Score Pro.
Of course. Yes, it is.
So,
Because
what is the easiest way to get out of debt, raise your credit score, and be ready to purchase a home? It's Credit Score Pro.
it
Because
is
with
credit.
Credit Score Pro, you can choose your goal of buying a home, and the credit action plan is going to tell you exactly what debt to pay down, by how much, what cards you should be using if they were stale, what kinds of credit building you should be doing. And at the same time, if you do have any negative information, things like late payments, charge offs, whatever on your credit report, collections, Credit Score Pro's AI will help you in disputing that, right? All you have to do is click a few buttons and the disputes are sent. So Credit Score Pro is really going to be the easiest way for your clients to get ready to buy, and in a way that allows you to take that client that we've been talking about, right? The non-ideal A-paper client, and turn them into somebody who is an ideal type of client to qualify for a home purchase. I stole your
Oh,
thunder.
you did. You totally. Well, you threw me a softball and I didn't take it, I guess. So I deserve that. But exactly what Ivory said, right? Credit Score Pro is free. Number one, there's a catch in that they do need to have credit monitoring. And Credit Score Pro uses Smart Credit as a partner, which is an amazing software by itself, and we can dive into that another time. But connecting that to Credit Score Pro allows Credit Score Pro to read that credit report, come up with those actions to dispute the items using AI, but also creating that plan that Ivory was talking about, and did such a great job detailing. It's when you have a goal and you have the steps in front of you of how to achieve that goal, to me that's priceless, and that's what Credit Score Pro gives you. And then on top of that, one thing I just wanted to point out, you said something, Ivory, about how Credit Score Pro, if you need to build credit, if you need new credit, it will advise you on what to do. And that is super important. There's so much going on in our world right now where social media influencers are talking about, get this credit card, do this credit card, all these tons of different credit building credit cards out there in the world. They are not all good.
Right.
And Credit Score Pro is going to direct you on the good ones. And, if you're going to Credit Karma, for instance, and you're looking at what they say and they suggest, they're getting paid big dollars for you to click on that and get that. It's not necessarily the thing that's going to help you the most, where Credit Score Pro is tailoring it to you on what's going to help you the
Yeah.
most.
They recently had a lawsuit too for telling people they were pre-approved when they weren't. So be careful. They've probably fixed those issues since then, because they would have had to, but.
Right. Yeah, but it's not in the reality for Credit Acorn or Credit Karma is not that they're trying to give you the best tools to improve your life. They're giving you what they think they can market to you that you'll buy. Right.
Make money on. So here's our next questions. How fast can you get credit scores up? It depends. I mean, it really depends, right? So if you're disputing negative information, creditors, credit bureaus, collection companies, they have 30 days to investigate, right? We don't know if they're going to take the full 30 days, if they'll take less time, if they remove the information right away, if they don't. You can use credit building tools like with what the credit action plan will provide. And some of those things are going to update pretty darn quick. But I don't know, Allie, if you can shed a little bit more light and explain things in a little bit more depth.
This question is commonly asked, right? I mean, everyone wants to know if they're working on their credit, they always want to know how fast, right? And keep in mind that everything's a process. And I just talked about how the credit bureaus have 30 days. The actual real definition is namely 30 days. Well, that namely means 45 days. So they literally have 45 days. But on top of that, they are like, they don't want to do their job. So what do? They say, oh, we got your credit dispute, but we couldn't verify your identity. Or, we think this is
Stall tactics.
all these stall tactics. So now we're adding time, right? So now we have to redo the process. So there's a lot involved in credit repairing your credit. Obviously, it didn't happen overnight. Maybe it did. It can. Unfortunately, like my client today lost 150 points from a third day late. But it does take time. But I would say if I were to be better on this, I'm seeing that people are coming through Credit Score Pro, those that follow the action plan, and that's key, right? You do the disputes, you follow the action plan, because disputes are not everything. So we like to tell you that Credit Score Pro is beyond disputes, okay? Because if you're relying on, I'm just going to dispute everything off my credit report, it's not going to work. Rarely does it work for someone to be able to buy a home. But if you follow the action plan, I've seen people in 3 months, they're ready to buy a house, and I've seen less time, but I'm going to give you the average 3 months. But I would say for the majority of people, they're looking at 6 months, right? Which I think is a short period of time, and it'll fly by really fast as you're working on things.
Exactly. How do you help clients build credit? I think we've talked about that a bit. So Credit Score Pro has an action plan that is tailored to the goal. So the client picks the goal, buy a house, whatever the goal may be. We'll keep with that example. And it is going to base the action plan on the algorithm that is used in mortgage lending, right? We want to make sure the strategy makes sense for the type of loan that the client's trying to get. And the great thing is once a client achieves one goal, they can pick a new goal, right? And it continues. So it's about the ongoing maintenance of getting and then keeping a strong and a healthy credit score. Okay, so your resources. So introducing Credit Score Pro. We already talked about it a bit, but what Credit Score Pro is multiple tools all in one. So it is the first program, software. I don't know what we would like to call it. System. That's a better word. It is the first system that really takes every aspect of managing credit and puts it into one. So we have AI-powered credit analysis and credit disputes. And you can see on the screen here, you'll see the user for Credit Score Pro clicks a button to create the dispute, chooses the items, and then the AI suggests the most appropriate dispute reason. So it takes the client away from having to be an expert on credit score algorithms, on laws and regulations, on how to communicate with bureaus, right? And it makes it very easy for them. It has credit coaching, right? So we don't just want people to fix their credit and then run into the same issues over and over again, right? And we want to make sure people understand the ways to maintain and keep strong credit. So we have an entire credit coaching section, which is just tons and tons of hands-on videos and resources for the users of Credit Score Pro, so that they can build on their knowledge and their understanding and be successful with their credit long term. Gone are the days of lack of financial literacy, and we want empowerment here to stay. So we mentioned the AI-powered action plan, right? Step-by-step guidance tailored for those specific financial goals based on the user's credit report. This is not this cookie cutter, you do this and it's the same thing told to your neighbor, the same thing told to your brother, the same thing told to your friend. These action plans are made specific to your report. So they are going to adjust as you pay cards down, or as a card becomes stale, or as there's new actions you need to take or new goals that you put in place. And then We mentioned the credit monitoring, or Allie did. We were partnered with Smart Credit. So there's credit monitoring built into it. So that way, users of Credit Score Pro always know what their credit looks like. And then we have an easy to use interface, right? We don't want it to be complicated. We want everything to be easy. And at the same time, for you as a professional, you can use the platform. You can refer clients to use the platform. We have the option for you to be an affiliate. So that way you know what's happening when it comes to your clients. Did I miss anything?
I just want to say, you mentioned that we are the first, Credit Score Pro is the first to come up with this robust system that provides all of these pieces. There is no other software out there that's doing that. It is a software, it is AI, it is going to provide these things that we just talked about. And it's in the palm of your client's hands. So they don't have to wait till 9 o'clock in the morning when the credit repair company opens, or miss the call at 5 and they're working different. All of that is gone. They don't have to pay the high fees for a credit repair company. Literally, it's inside this box, right? That's in the palm of their hand. They're able to manage their credit, fix their credit, get to their goal. It's just, to me, it's, as a lender in the past, I'm really jealous of you guys that you have this tool, because I did not have this tool. And matter of fact, back when I was in lending and we first started lending, there was nobody out there that was providing services to help people. That just wasn't a thing. And
Yeah.
so you have this now, and when we're in this market with these people who are credit challenged but want to buy a house, and now you have a tool to help them get there, you don't have to do any extra work. You're sending them to Credit Score Pro. You're done, but now you're still the hero. They're coming back to you. They're sending everyone they know to you. I'm telling you, if you are not referring your people to Credit Score Pro and an affiliate of Credit Score Pro, you are missing the boat right now. So I encourage you to go to our website, creditscorepro.ai. You can sign up to be an affiliate, and we'll get you out the information and help you build that pipeline for yourself. Be a star in this market. Like, don't let those of you who said that 2023 was bad. I'm telling you, it's because you didn't use Credit Score Pro. Use Credit Score Pro, start out 2024 good. And when the market changes, we'll let you know. And there's a new way to do things, right? But right now, this is where it's at.
And Allie, we have a question in the chat about the cost of Credit Score Pro. I know we mentioned it very briefly earlier, but if you want to go ahead and answer about the cost.
Yeah. So the beauty of it is we meet people, and that's why we create the software, because if software can do it and AI can do it, we can make it cheaper for people. So we can meet people where they're at. It's not a high cost item. So Credit Score Pro is actually free. I like to say there's a little catch to it. You do have to have credit monitoring. So in order for us to have the credit report that Credit Score Pro software needs to read, we partnered up with Smart Credit. Smart Credit charges a fee of $39.99 for access to use Credit Score Pro. So once they pay that, they have full access to Credit Score Pro. There's no like catches where you don't get something. You get the full thing for your credit monitoring price, and that's monthly, so you can use it as long as you want. I mean, it's very friendly to the consumer.
So how Credit Score Pro can help you and your clients. I thought it'd be great if we showed an image of an action plan. And I chose this one specifically because the credit scores here are high, right? And this just goes to show you that even if you have high credit scores, Credit Score Pro is really there to help you maintain and keep those high credit scores. So again, automated dispute letters, interactive learning, debt management strategies, and the credit action plan. I think we did a great job already talking about that. So I'm not going to touch too much here. Just thought the image was nice to see as well. So
yeah. And I would just, the only thing I would add to this is we had someone on one of our webinars a while back, or one of our lives a while back, and it was actually a loan officer, and he had mentioned that it doesn't matter what your credit score is. You should have Credit Score Pro, because it's going to alert you if something changes. And if something changes, you can take care of it right now, right? The faster you take care of something, the better you're off to getting it off the credit report. So it's there, and you got the action plans for different goals that may not be, that you have a negative thing on your credit report. So that's great.
Exactly. And that was the perfect segue. That's exactly what this next slide was about. It helps you identify errors and issues on your credit report immediately and take action. So you already said it.
There we go.
So what can Credit Score Pro actually do? It can provide people with credit scores who have no scores, right? What is your path to getting a credit score? And then it can help you improve damaged credit and rebuild strong credit history and maintain those strong scores. It identifies solutions that mortgage loan officers, simulators, and rapid rescores can't solve. I think that's really key for any of you in the mortgage industry. And it gets more buyers into homes, right? We're able to help more people take that next step, build financial literacy, and ultimately build wealth for generations to come.
Can I just say one thing on that? And I know
Mhm.
you're gonna tie my mouth shut because I always talk too much, but this happened the other day. I just want to bring this out. There are a lot of mortgage lenders who are using Wayfinder, right, for
Mhm.
their advice to their consumers. And I tell people all the time, like that they'll give you some information, right, to help
Mhm.
them. But be careful. I had one of my loan officers sent his client a Wayfinder. I was CC'd on all this because I'm
Mhm.
the credit coach. And the Wayfinder literally told the client to pay $115 on her student loan when the bill, the monthly payment requirement was 215. Wayfinder said, we found that if you pay $115 on this student loan rather than 215, your credit score will improve. Had she followed that advice from Wayfinder, and I'm going to take a clip of that. I'm going to let you put that in a slide for another time. But had she followed that, she would have had a 30-day late on her credit report.
Great.
So that's
Wow.
my little soapbox on Wayfinder. It's not going to give the specifics. It's kind of a generalized idea, and
Mhm.
it's not always correct.
Mhm.
And where our action plans would never would never allow that kind of thing to happen, right? So I think that's important.
So if you stayed with us thus far, you can visit us online at creditscorepro.ai. There you can access credit building tools. You can access Credit Score Pro and all of its features. And then you can also become an affiliate if you'd like to refer your clients and make sure that your clients are able to have credit success. We will be following up with you for those of you who did register for today's event and make sure that you have additional information on Credit Score Pro and give you the link for becoming an affiliate. We also encourage you to join us on our Facebook group. So it's called Credit Score Pro, the AI Credit Revolution. You can join that group, ask your credit questions, discuss scenarios you've run across with your clients. And then just be there to answer questions. It's great for us to have professionals that can be resources for our clients who are looking to have their questions answered about things like mortgages or other lending products, right? We rely on a community so we can all help each other succeed. So with that, I'm going to stop sharing my screen. And do we have any questions left in the chat that we have not answered? I think we only have time for one, just because we are a little over on time.
We're over. We're over. And I apologize for that, Ivory, because that's my fault. But I think I decided to still my mouth shut. We do have a message in the chat, actually.
Okay.
There's a couple of them. Let me see if I can. It's not the right one. Okay. Um, let's see. I'm trying to pick one that there's a lot of them that we've already answered.
Covered.
So yeah, or variations of that are still the same answer. So if you don't get your question answered, or you feel like you didn't, because like I said, there are a lot of them are the same variations. Please just let us know, and we will make sure
Mm-hmm.
to answer for you. But this person was just more. Maybe this is a good one. I'm gonna pick one. So this was about the FICO 9 and
Mm-hmm.
the mortgage FICO.
Mm-hmm.
I guess they also had that incorrect understanding of the how those algorithms work. And
Sure.
that's something that's really common because there was a big hype on FICO 9. Do you remember
Yeah,
that, Ivory, when
I
FICO 9
do.
came?
Mm-hmm. I do.
And here's what I'll just tell you. This may answer your question without answering the whole details of your question. FICO 9 came out and there was big hype around it. Everyone was excited about it, and then no lender used it. So, so let's just put that out there. If there are a few lenders, I forget what I was at a conference and the credit
I
bureaus were
saw one
there.
recently too, come through,
Yeah.
come across our desk.
I believe if, and
I
you
don't
can
remember
quote
who
me
it
later, you can
was.
check on this quote. Don't quote me, check
Okay.
on it later. But I believe, if I remember right, the credit bureaus told us that there was only 10 companies that actually transitioned to
Wow.
FICO 9. I believe that's the number, was 10. So
Wow.
if you get lucky and you get a lender that uses FICO 9, you will have a higher credit score because,
Mhm.
yes, there are some things that are not as heavy of a weight on that scoring system, like the medical, for instance,
Mhm.
than is on your mortgage. But you know me, Ivory. I always say the mortgage one is the mean one, guys. It's just the mean
Mhm.
one.
It is. It's
You
true.
know?
It's true. It's
Mhm.
the oldest. It's I was gonna make a joke there, but I'm gonna save that joke.
We all like jokes. Come on, we're
No,
we're
no, no.
loan officers here. Come
It's
on.
okay.
You've been in the room
Well,
with a bunch of loan officers.
well, I suppose we should wrap it up for today. But as a reminder, we are live every week, every other Thursday for professionals, and the opposing Thursday for consumers. So if you have any clients that you think could benefit from any of these live events, feel free to send them the info. You can find us on Facebook. To get access to all the upcoming events. That's where you can register. Otherwise, if you have attended today, we will make sure to remind you that events come every Thursday. And with that, we will let you get back to the rest of your day. And thank you so much for joining us.
Thank you, guys. Bye.